In this video we are going to talk about the Gamestop situation. So before starting this video, please like this video, subscribe and turn on the notification to our channel for future updates. Gamestop is a video game, consumer electronics, and gaming merchandise retailer based in the United States. The business is headquartered in Grapevine, Texas, United States, and as of February 1, 2020, is the world's largest video game retailer, operating 5,509 retail stores across the United States, Canada, Australia, New Zealand, and Europe. The company was established as Babbage's in 1984 in Dallas, and took on its current name in 1999. The retail stores of the company mainly operate under the brands of GameStop, EB Games, ThinkGeek, and Micromania Zing. Due to the shift of video game sales to online storefronts and GameStop's failed investments in smartphone retail, the company declined in the mid-late 2010s. GameStop, the video game retailer whose stock is suddenly the darling of day traders who are putting the squeeze on Wall Street's big players, is inflamed by the internet and stock market. The stakes are huge. On Wednesday alone, the surge in trading increased GameStop's value by more than $10 billion. The stock fell 44% on Thursday as several trading platforms temporarily imposed restrictions on it, only to rise again on Friday after the restrictions were lifted. The combination of traditional investing, rampant enthusiasm, stock market mechanics, and the belief that anyone with a Robinhood account can meme a fortune into existence is exactly why GameStop's value on paper has rocketed to stratospheric levels. What's going on? It is called a short squeeze, and it involves investors betting on the way up or down a stock will go. By buying the shares themselves, or stock options, these bets are placed, which we will grossly oversimplify here. Investors betting against a stock are referred to as shorts. In the case of GameStop, the short films include at least two large hedge funds. Shorting a stock entails borrowing shares from a broker and selling them with the understanding that the shares will be returned later. You buy back the shares when the price falls and pocket the difference. But if the price rises, you can lose big if shorting a stock is risky. You can't always avoid making a bad bet. However, you could lose if someone tries to drive up the price by buying a large number of shares, even if the company isn't doing anything unusual. This is the situation. Shorts have to close their position, which is, buy up and return the shares they owe to their brokers. This demand propels the stock higher, putting a short position at risk. Usually, sophisticated Wall Street investors are involved in these types of standoffs, for example when Bill Ackman squared off over the dietary supplement maker Herbalife against two other billionaires, Daniel S. Loeb and Carl C. Icahn. Why did GameStop's stock start rising? Amateurs began driving the price up. Armchair traders have flooded the market in the last year. After stocks fell last spring, some smelled chance, some tried to scratch a gambling itch after sports leagues shut down, and for some, it's just a game trying to ring up dollars instead of points. The free trade available through platforms such as Robinhood and E-Trade has all made this easier. Some of these enthusiastic amateurs purchase GameStop shares, but many place their own bets on options on the opposite side of the shorts. These bets entail contracts that allow them to purchase a stock at a specific price in the future. The trader can buy the stock at a bargain if the price rises, and sell it for a profit. In practice, many traders simply sell the options contract for a profit or loss rather than buying the shares, but for our purposes, this description suffices. If the trader wants to exercise the option, the brokers who sell the options contracts have to provide the shares. They buy some of the shares they'll need to reduce their risk. This small amount of demand usually doesn't do much for the price. But if enough traders bet big, the stock can be pushed up by demand. If it goes high enough, more shares have to be bought by the brokers who would be on the hook, lest they get stuck having to buy a lot of expensive shares all at once. That increases demand, which raises the price of the stock. Which means the brokers have to buy more shares, which means you get the idea. Okay, but why GameStop? Reddit's Wall Street Bets forum, one of the stranger places on the internet, can take some of the blame. Armchair traders gather on Wall Street Bets, or WSB, to share memes, commiserate over losses, and share more memes. They do, however, exchange tips and analyses that can go on for pages. Late last year, GameStop's stock began to rise after the founder of the pet supply website Chewy bought a stake in the company and was appointed to its board of directors. Slowly, WSB and traders who frequent the gamer-friendly social media service Discord gained the company's attention. The motivations of the traders are diverse. There is a reason why the shares of GameStop are of good value. Others are just wave riding. Others want Melvin Capital, a hedge fund that was shorting GameStop, to be punished. They're the ones who quote Heath Ledger's Joker from The Dark Knight, who says, "It's not about money, it's about sending a message." However, amateurs aren't the only ones who engage in aggressive maneuvers against the shorts. The big players on Wall Street recognize a good opportunity when they see one. How does the GameStop squeeze end? Nobody knows. Robinhood, Interactive Brokers and others placed more restrictions on GameStop trading and other stocks that were caught up in the frenzy on Thursday. For example, Robinhood limited the capacity of traders using its app to purchase call options. The rally was deflated as a result of these moves. After those were put in place, GameStop fell, reversing a 30% gain earlier in the day. Then, some of the restrictions were reversed by the trading app, and the shares rose 65% on Friday. Due to the squeeze, a Melvin Capital spokesman who needed a $2.75 billion cash injection on Monday said the company had closed out of its short position. Another short by Andrew Left of Citron Research said he had covered most of his short position, at a loss, 100%. There's a catch: as a company, GameStop does not differ noticeably from a month ago. Its share price is wildly inflated by any conventional measure and extremely risky for whoever owns its shares. But this is no longer just about GameStop. Enthusiastic amateurs, like the movie theater chain AMC Entertainment, American Airlines and the smartphone manufacturer BlackBerry, are also bidding up the prices of other struggling stocks. However, this strange little bubble has an impact on more than just the bettors. If big investors on the losing end of these trades need to raise money to cover their losses, they may have to sell enough stock to hurt the prices of otherwise solid stocks. If the sell-off is large enough, it could have a cascading effect, resulting in larger losses for investors who have never purchased or sold a GameStop stock. So that's it for today's video. What do you think of our list? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button and turn on notification before you go. Thanks for watching.